How did I determine my stock to bond allocation? And hang on to the end of this one. I don't know of anybody doing it the way that I am. Now, that could be a little scary, but it makes sense to me. So hang on for that. I'm going to build to it. There are hundreds of videos out there, a lot of articles on determining your asset allocation. Okay, I've seen probably most of them. I spend a lot of my time doing research. It's a hobby. And my part-time job, managing my own investments. Today, I'm not going to talk about inside of stocks, what to invest in, what I invest in. That's a future video, international, large cap, value, small, all that stuff. Just purely going to get into stock to bond allocation. Why I selected it, why it makes sense to me. There are a lot of rules of thumb out there. When I was probably 30 or 40, the rule of thumb was 100 minus your age. So I'm 59 right now. Let's say I'm 60 for easy math. That would say 100 minus 60. I need 40% stocks. Well, that just seems crazy to me. It seems extremely conservative. But since then, I've heard 120. I've heard 130. I've even heard 140 minus your age. Well, that creates quite a range there. I'm not sure that's extremely helpful. You know, having between this, you know, these rules of thumb, say between 40 and 80% stocks is what I should have. Thanks, right? I'm not sure that's very helpful. A lot of times, you know, you hear when you're in retirement, you hear 60-40, 60% stock, funds, 40% rebalance annually. Great, simple, easy to do. Bill Bengen, you've heard of him, 4% rule. I won't go into that. He did analysis using 50-50. Stocks to bonds, and you can increase the payout in a later work if you use higher than 4% if you have some international exposure, and you can increase that 4% if you use guardrails on spending. Like if the market is down, you may not take the inflation adjustment. So there's different ways of getting higher than the 4% rule. He states in his paper, you know, to be between 50 and 75% stocks. So, hey, one of the things I'm going to do is that I'm going to attach a video by Rob Berger that does a great job with all this rules of thumb. I think I'm not going to repeat it because it's great. Take a look at it. It'll be the first link. All of this, these rules of thumb and, you know, all this math of 120 minus your age, 140 minus your age, all that's based on using history as a guide and doing something like spending 4% adjusted for inflation. But there's decades where it's below, the market is below or above those averages. So what works for today? Bill Bengen's 4% rule was based on the worst year. If you had this 50-50 portfolio, the worst year. Do you really want a plan that is that conservative? What was the second worst year or the worst 5%? Maybe that makes more sense for you, for your risk profile, because you're going to put guardrails on your spending. So to me, all this, all the work out there left me hanging. I mean, I'm hanging. How does this apply to me? What percent do I want to use? My next comment in here is around, the 4% rule. What if you're spending less than the 4% rule? What if you need to spend more? What allocation? So there's just far too many things that just doesn't solve for me. Maybe this is my engineering background, my management background. I need something, a little more guidance than, hey, somewhere between 40 and 80. And it can change based on the year that you choose to retire and start drawing out these assets. Just not working for me, for my peace of mind, my confidence to spend, and opportunity cost. I don't want to take a lot of risks since I am retired, but I don't want to miss out on opportunity of growth if I've got, 10, 15, 20 years to be in the stock market, 30 years, hopefully. Anyway, so back to some basics, and I'm just trying to build a logic train for you. Why stocks? Historical growth, right? Beats inflation plus growth. Downside, boy, there can be some negative years. We don't care about positive volatility. You don't care if the market as a surprise like 2023 was up 25%. You just care if it's down 25%. Why bonds? Bonds provide some growth, sometimes keep up with inflation. There's perceived less risk. It's kind of to buffer some of the stock losses. So if stocks are down 20%, sometimes, stocks may return 5-6% and buffer that a little bit. But that didn't work too good in 2022, right? Now, we don't need to, have our recency bias of thinking that's going to happen all the time, but it was an ugly year for both stocks and bonds. But bonds are meant, and you hear this a lot, to buffer. There are some measures of this, when you're looking at buffering your wild swings. You can look at standard deviation. That's very common, but that measures variability around an average, plus and minus. So if there's more positive variability, is that really a bad thing? It's a measure. Makes you feel good to have a measure. I think it's good, but it's not anywhere close to great. It's just a calculation. Max drawdown is a number to look at. Say, okay, with these investments, what's the S&P 500 I've got? What's been the max drawdown last 50 years? I look at that and said, hey, if I have my max drawdown with 100% stocks is 35%, and if I have 15% bonds and it's 27%, does that make me feel that much better? And this is foreshadowing, but what's important to me is not how far it went down, but how many years till it recovers, okay? How many years till it recovers is more important. And do I have a buffer so that I don't sell my stocks when they're down? Like in 2022, when they went down, my bucket 3 was down about 30%. How long did it take to come back? If it was down 30% or 35 or 25, that's not as important to me as when's it coming back. If I've got a good plan and some safe assets to weather that storm, I can have confidence to spend. Hopefully that makes sense. There is a ratio out there called the Sortino ratio that measures downside volatility only. So you can compare some funds that, have where they are versus in total variability, but just looking at, I'm doing a bad job of this. It's a metric that measures volatility on the downside. It only accounts for when it goes down, that difference, not the total swing of highs to lows, just the down. Okay, we have not met. My name is Joe. I'm 59 years old, been retired for 5 years. I'm a degreed engineer, worked in operations management most of my career. I'm trying to share my retirement journey with you and logic with you, my thinking with you, just as an experience for you to maybe help you in your decision-making process. Maybe retire a little bit earlier, maybe have more confidence in your plan, or decide, boy, I just don't want to follow Joe's plan. This is my story. I'm not saying it's right. I'm saying it's my thinking, my logic, where I'm at. Okay, so I think this helps. Let me know in the comments. I've never been a fan of bonds, okay? Most of my career, I was 100% zero, no bonds. I'm telling you, until I was probably 45 years old, had zero safe investments, other than, maybe 6 months in a savings account. But 100%, I believe in the spirit of people. Maybe this is because I was in manufacturing. I believe that there are so many people trying to make a profit, trying to make good products, good services for people. I believe in people. That's why I like the stock market. We're going to be better 10 years from now than we are today. Innovation, technology, people. Bonds, yeah, they are market driven, but to me, maybe my cynical side, they're often manipulated by people's interpretation of the economy. You got the Fed trying to do things, to manipulate the market. And I just don't have as much faith in that. Anyway, so in the last few days, I've added a bond fund to my portfolio, and I got lots of reaction to that. I use buckets, so this money, this bond fund, I put into and made my bucket two money. Bucket one money, as a reminder, I have 4 years out of the stock market. I've got it in things like very safe assets like checking accounts, savings accounts, CDs, money market funds, I-bonds, really pretty secure things. My bucket two, the shift I made, is now a bond fund. I used a Fidelity Total Market Bond Fund. Got a lot of questions on that. So that's what I'm currently doing. Combined, these are about 10 years of needed funds for my expenses, okay? Now, these aren't my total expenses because I have some other income, okay? I have a small pension. 10 years from now, I should be taking Social Security. I'm planning on taking that at 69. Got another video on that, okay? Why I'm taking Social Security at 69. I have a deferred compensation account where I did not take all my salary for several years, and that pays out over 10 years. Separate video. I don't want to get caught in that, but that's something that I'd started saving outside of my 401k pre-tax and had it paid to me over 10 years. That's helping. I also get a little YouTube revenue here, and I do some coaching on reliability and maintenance. Not a lot anymore. I used to do much more of this when I first retired, but it's income coming in. Doesn't cramp my retirement lifestyle. So at 69, my need for investment income goes down quite a bit because I'm taking Social Security, and my wife will get half of mine. She's 2 years younger than me. She's 67. So that's when she maxes out on the percentage of mine that she can get. That's why I'm taking it at 69 instead of 70. If that makes a little sense, that's in another video. Honestly, taking Social Security at 69 drove a lot of my logic for 10 years. I'm 59 plus 10, 69, Social Security kicks in. So 10 years safe with air quotes, assets. I know bonds can go up and down, but I think the market, this is going to be market timing for you. When bonds were paying near 0.1%, I think the only opportunity for bonds was to go up. Now that we're up, in the, 5.5%, 6% Fed funds rate, that the opportunity, and all analysts are really predicting it's going to stay the same or go down, which will help bond funds. So I think it's an opportunistic buy and an opportunity for me to rebalance a little bit. You'll see why rebalance is important to me in a second. So that's what drove my 10 years safe. Is I'm 59, gets me to 69, and then I got Social Security, I got my pension coming in. I can cover my basics with that very easily. To me, having a percent asset allocation does not equal confidence. If I'm 60-40, what does that tell me? That tells me 60-40. That doesn't tell me if the market goes down 30%, how many years can I spend? Can I spend for how many years? It really just, yes, I got all these historical studies that said on average you should be okay if you're pulling out 4%, but what about 2024? So that saying I got 10 years in safe assets means a lot. Confidence to spend, all that stuff. 60-40, what does that mean? What does that mean to me? Okay. So let's see, where am I at? I'm on 19, bullet number 19. Okay. Presently, here's the big reveal. I'm 77% stock funds. That's what I call bucket 3, and 23% in low risk. That's my bucket 1 and 2 added together. Again, all my income sources are kind of pulled out of that. So 77% stocks is what I've got. So this is on the high end of the rules of thumb. If you remember, the rules of thumb went to somebody that's 60 years old, 40 to 80, 77. So in there, in the range, but on the high end. So I would be considered an aggressive investor here. No pride in that. But I didn't. You'll see how I got to 77. The big reveal is my year's safe. Here's what I want you to think about. My year's safe investments, bucket one and bucket two, dictated my stock to bond mix. I didn't use a rule of thumb. I didn't go in and say, well, everybody said 60-40, you know, Bill Bengen said 50-50. I didn't do that. I said I wanted 10 years safe. I looked at, that takes me to Social Security. I looked at the length of stock market crashes, bear markets, and how long to recover. That was a previous video. That was just a couple videos ago. I talked about how long they last. You can remember 2000 to 2010, 10 years, that's 11 years, depending on how you want to count it, before the market recovered. Okay, so how long it doesn't matter how long the bear market was. It matters how long, when it starts to when it reaches new highs again. And so I chose that I wanted to cover 10 years of that. 10 years also happens to be the age, you know, difference between myself now and at 69. So that's where the 10 years came from. And then the rest of my assets are in stocks. That ends up being a 77-23 portfolio. I did not start off with my asset allocation first and then determine years safe. I determined years safe and then calculated the stock bond ratio. Hopefully that makes sense to me. Let me know in the comments if I need to do this again. But I started with the years safe, and the allocation was a result. I didn't start with the allocation. And I think everybody out there I listen to, maybe I'm biased, says determine your asset allocation, you know, and then just starts doing all this math, you know, and where you should put all your stuff and how do you come up with your asset allocation. I back into it. It's not a number I try to manage, but that 77% is actually after I bought this bond fund. I was in the 80s. So going forward, I expect my percentages will change, really, because that's the tail of the dog. My percentages may change, but you know, something like maintaining 10 years safe makes sense. Now, as I take Social Security, my 10 years safe is going to be a smaller number, right? Because I got the higher income, my need for my investments is a smaller number. But maybe when I'm 75 years old, I'll still want 10 years safe, and then everything else could be in investments. So, or not in investments, in stocks. Who knows? I'm telling you my current thinking, my current math, but I can see that going forward to being a smaller amount because of Social Security. Does this make sense? Okay, let me know in the comments. Does this make sense to you? Do you think I'm completely wrong? Do I got this all wrong? Am I making this too complicated? How do you determine stock bond allocation? To me, this makes sense, gives me confidence. I know when the market goes down 40%, 50%, whatever it goes down, I've got 10 years pretty safe, okay? You can have events like 2023 that may bite into that with bond funds going down, but 10 years is a long time. We have had events that have been in that duration, okay, in that time period. I wouldn't feel comfortable only having 2 years safe, okay? And I wouldn't feel comfortable having 20 years safe. Doubling my bond allocation, safe asset allocation to become 50-50 just makes no sense at all to me. I feel like I'd be wasting opportunity if I did that. So again, let me know in the comments what you think. As you always do, it's Joe out.